So thank you so much again for joining us. My name is Jacques Dupree. Most of you in this webinar know me. So I'm busy doing a series called The Mortgage Life Cycle Costs of a Mortgage. And why do we do that? Okay, and so here's why. And I'm gonna, I kind of stop always gonna talk about it because most people don't know what I'm about to tell you. Our Canadian banks are what's called a saturated oligopoly. Now, if there's economists in the meeting, that you'll understand that an oligopoly is basically when there are very few but very large and very powerful players. Okay, and in other words, they know that they are very big, and if they start competing with each other on price, they will literally potentially ruin each other. Okay, so well, look at our top 6 banks. They're all significant institutions. Okay, so literally, this is not because I said so. It's because this is a common fact, and I quote basically from an article a professor at University of Toronto wrote, I believe it's in 2010. They're an oligopoly, so they don't compete on price. What is price in mortgages? It's interest rates. Okay, it's like, whoa, Jacques. Mortgages, you don't compete on interest rate? No, they don't, because again, they'll drive each other to the ground. And you can check this anecdotally. If you go to various banks' interest rates, guess what? They're very close to each other. So then, while they're very profitable, what do they compete on? They essentially compete on image, believe it or not, and retention. That's the bigger one. In other words, terms and conditions to kind of make it hard for us as clients to leave them. Okay, so in other words, what that means is we caution you that an over focus on interest rates may blind you to other costs that'll cost you a lot more. Because here's a good example, in 2020, 21, when rates were very low, some clients were sitting with rates of 3.69. They try to get into the 2 point somethings and the 1 point somethings. Well, to leave the mortgages, some of the penalties were like $40,000. Okay, and that's exactly right. There is a retention strategy. So that's why I spend time on this, because so many people we've been trained, and this is not, I don't think it's an indictment on clients, it's an indictment on the financial industry for not educating clients to say, listen, don't over focus on interest rate, right? Most people just want to know the rate, and I get it, right? It's because you want to pay less. I totally am with you there, but if you don't focus on terms and conditions, you're going to pay more for the wrong mortgage, even though your payment might be slightly lower than another one because of bad terms and conditions. Okay, and so why do we write these articles? I'm sure you got a lot better things to do on a nice July afternoon, because we believe that clients are educated to actually make better mortgage choices. And I always say, I would like to be your long-term friend, including to be invited to your mortgage burning party. Okay, I just believe I make more friends by educating you and then to try and just get you with a rate. I don't work that way. Cool. Okay, so we're going to cover, as I said, mortgage amortization. And so here's the key. Why do we spend time on something so inconspicuous as an amortization period? It is precisely why I spend time on it, because an unmanaged amortization period can be very limiting and actually can cost you a lot of money. Okay, you'll see that in a second also. All right, so let's start to dive in and see what we can make of this. Okay, so first of all, let's differentiate between the amortization period and the mortgage term. This is an important distinction. Why? Because in the United States, I believe they don't have a term. So in Canada, what is the term? So amortization is typically the time it takes. We'll get into the, actually, let's do it right now. So the Merriam-Webster dictionary says to amortize is to pay off an obligation gradually over time, usually by periodic payments until of principal and interest. So that's a mortgage, right? You start at whatever, 25 years, you gradually pay the mortgage off with principal and interest payments until it's down to zero. Okay, so let's define it like properly, or summarize it. It is the length of time it would take to pay off the mortgage in full based on minimum mandatory payments at a certain interest rate. Okay, so an amortization basically could be 25 years or whatever you want it to be, as long as you qualify for it. What is the mortgage term then? Okay, so this is what I believe the Americans and other countries may call the term. We call it the amortization. And then inside your amortization in Canada, we have term lengths, and that can go from 1, 2, 3, 4, 5, 7, and 10 years. Okay, and so we call these contract periods the terms. And if you look at the previous webinar, that's exactly what I covered there in that. Okay, so that's why. So we've just differentiated between the two, and now let's start to look at what some aspects about the amortization. So here's, in the mortgage industry, you've heard me say this quite a few times in this webinar, is that we use a lot of slang or colloquialisms in the industry, and then we kind of paint ourselves into a corner because we cannot actually use the proper words anymore because people won't understand us, okay? So then we will just perpetuate the slang and we confuse people even more. All right, so let's look at interest-only loans, okay? And so what's an interest-only loan? A home equity line of credit, a HELOC, okay? So we call them all mortgages. They're not a mortgage, okay? They are a secured loan against real estate. So why is it not a mortgage? Because remember, for a mortgage to be a mortgage, it must have an amortization. For it to be an amortization, we must have a starting point and we must have an end point here, okay? A line of credit or an interest-only loan does not have that because you don't have a fixed principal and interest payment. Okay, you can pay typically interest only, so it can literally carry on into infinity. All right, so anybody who tells you that their HELOC is a mortgage, it is actually technically incorrect. It is a secured loan against, see there, against real estate. All right, important to note that. My mom used to say I'm a hive of useless information. There you have it now, okay? Okay, so then let's look at the relationship between the variables, okay? So how do these things work together? Basically, a mortgage's amortization period, the payments, the interest rate compounding, how often is interest added onto interest, and the loan balance are all brought together in mortgage formula. And they are a compounded interest formula, okay? So it's exponential, the formula. So in other words, it's not a straight line. It's not like a straight line graph. It kind of like goes to a curve like that. That's really important for you to know. In other words, what this all means in kind of plain English is if your interest rate goes up, then some of these other things are going to move. Or if you decide to pay more than the minimum payment, then some of the other variables are also going to move. For argument's sake, here, all things being equal, the amortization period is shortened with increased payments or reduction in the mortgage balance or vice versa. Because if you put extra money into your mortgage, your amortization is going to come down. All right, important to understand. Now, these are important because we're going to use them shortly in mortgage strategies. Okay, very important. Okay. Interest versus principal. All things being equal, for in each payment that you pay in a mortgage, okay? So the payment looks like this, okay? Now I'm just gonna like somewhere in today's rate environment, you're gonna pay less principal than what you are gonna pay interest, okay? This is what it looks like today, okay? But as you pay the mortgage down month after month, this line is going to shift slightly here towards, and how much your interest is going to become less and your principal is going to become more over time. That's basically that is exactly the nature of the exponential curve, okay? So basically, you've got a curve like this here. Let's just say your mortgage is $300,000 and you decide to pay it off over 25 years. It's going to look something like this, okay? That's basically what it says. Okay, so in the beginning, it feels like you're not paying this thing off at all, and you're paying a lot of interest. At the end year, you're going to pay a lot of principal and almost no interest until the mortgage is paid off, okay? Okay, so this kind of brings us to the same point here. In Canada, people say, well, Jacques, if I pay like $60,000 or $30,000 or $20,000 into my mortgage extra, is my payment going to stay the same? Yes, it is. Why? Because we have blended mortgage payments. What does that mean? So inside here, if this is our mortgage payment, for your full term, the payment will remain the same. So let's just say it's $1,500, the payment, okay? That $1,500 principal and interest will remain the same. Inside, it will shift, Okay, if you pay your mortgage down faster, more will go towards the principal and less towards the interest. That's really, really important to understand. Okay, here's what you may not have known, and this is such a sad thing. Okay, watch here. While blended mortgage payments, these are blended that I've explained here, we kind of only see this, right? We only see like I pay $1,500 for the next 5 years, and then after renewal, my payment may change, and then it stays the same for the next 5 years or whatever term you choose. There's another option, okay, but it's not available. It's like saying to you, I've got a massive cake for you, but you can't have it, okay? It's a bit crazy, but it shows you a little bit. Watch here. While blended mortgage payments offer predictable budgeting. In other words, the payment's the same for the next 5 years, okay? The borrower pays more interest compared to fixed principal payment mortgage payments. What? There's another option? Yes, and why do you think it's not offered to you? Because in the fixed principal mortgage payment method, you pay less interest and the bank gets less money, all right? So how does the fixed principal it's like me giving you a cake recipe, but you can't make the cake. I'm sorry, but I just want to show you anyway. So what happens is in a fixed principal a mortgage, the amount is decided that you pay off against. So let's just take our $1,500. I'm just obviously taking random numbers here. $1,500, and let's just say you set that amount at $800 a month. That's going to go towards principal. Well, guess what happens? This month, the payment, let's just say, is $1,500. Okay, but now guess what happens? You pay $800 off the mortgage balance, right? So that means the mortgage balance now becomes less. Well, for your next payment, guess what happens? You're still going to pay $800 on the principal, but your payments, again, I'm using no scale here, but your payment's going to be, let's say, $1,450. Why? Because you're paying less interest because you're paying the mortgage down. So guess what happens? You're paying $800. That part stays consistent. The interest shrinks all the time. So you're hammering the living daylights out of this mortgage. Wouldn't that be cool? If it was me, I'd be like, I don't care about the budget. This is what I want. It's not being offered. It's so sad, because we would be able to do that and pay our mortgage off faster. So just so you know, it's probably like you don't listen to anything I say after that. Like, what? I want that, but unfortunately it's not available. So blended mortgage payments is really essentially your payments stay the same. Even if you pay extra against the mortgage, your payments stay the same. Now I hear you say, well, what if I increase my payments? Yes, you can increase your payments, okay? But if you then want to back them off later, your minimum mandatory payment will remain the same. Okay, cool so far? All right, let's look at amortization types. Now, you're probably going to turn your head a little bit and say, what are you talking about, Jacques? Did you know, okay, hope you guys are all okay, and hopefully this is helpful to you. Did you know that your mortgage actually has 3 amortizations that we use in the industry? And it is really, really important to understand the difference between those 3, because all 3 can impact you significantly. And because it's so misunderstood, it's not used, okay? And it should be used because it's such a great tool. Okay, so a mortgage usually has 3 amortization periods. The qualification, the contractual, and the actual amortization. Okay, let's dive in here. The qualification amortization period is the amortization period that the lender uses to determine your maximum mortgage eligibility. Okay, what is the maximum mortgage you qualify for? Okay, and then so the qualification amortization period must be less or equal to the contractual amortization period. Don't worry about that. We'll get that in a second. Okay. So in other words, what does all of this mean? Okay. Is you may be able to pay the mortgage at a 30-year amortization. Okay. But for certain complex loans, such as home equity lines of credit, we need to qualify you at a 25 years. So here, maximum overall qualification amortization period for a mortgage HELOC combination must be 25 years, even though the mortgage portion can be paid at 30 years. So we must qualify you at that, even though you can pay it at this. Okay, so in other words, it's again forcing you to qualify for less. That's what the qualification criteria is. Now, once we've qualified you and you qualify at the qualification amortization, we essentially then it's out the door. Once you pass the test, so to speak, then we go into what's called a contractual amortization. Now, there is a lot of confusion between the contractual amortization and the actual amortization. So what happens with the contractual amortization? This is the mortgage's contractual amortization is usually the stated on your mortgage commitment. This is a 30-year or 25-year or 20-year mortgage. Okay, that's your contractual amortization. In other words, if it's, let's just say 20 years, if you pay the minimum payment, interest rates don't ever change, it'll take you 20 years to pay off that mortgage. That's your contract, okay? And as I said, that's what it determines there. A mortgage's contractual or actual amortization periods are usually equal on the closing date. So your actual amortization and the contractual amortization, I know it gets a little bit dilly here, I'll explain, are the same on the starting date of the mortgage, okay? But and if you pay nothing extra, they will remain the same, okay? But let's look at the actual amortization. All things being equal, a mortgage's actual amortization period usually remains equal to its contractual amortization period if the borrower makes no additional payments, as I just said. However, the actual amortization period usually reduces to less than the contractual period when a borrower pays down the mortgage balance by utilizing the mortgage privilege. Okay, so let's look at some examples. Making lump sum prepayments or increase the regular mortgage payments will make sure that making lump sum or increasing regular mortgage payments to exceed the minimum payments will reduce your actual amortization. Okay, so let's take an example. So you decide that you're going to be, to get a 30-year mortgage or a 25-year mortgage, but you pay a little bit extra. Okay, that would mean then after 1 year, okay, so 30 after 1 year, your contractual amortization would be at 29, right? But let's just say you've paid extra. And so you'll see in a second, you get a statement from your lender and it says your amortization is 27 years and 6 months. So what does that mean? It means you're actually going to take, if you continue to pay what you do, it's going to take you 27 years and 6 months to pay off your mortgage, not 29. Okay, and so why do we even play around with this? You'll see in a second why this becomes an incredible planning tool for you. Okay, and you should never lose sight of your contractual amortization, and you'll see why in a second. Okay, so remember that your lender's statements, okay, during the mortgage term and at mortgage renewal, very important, usually states the mortgage actual amortization and not its contractual amortization period. But you want that. You want the contractual amortization so you can make some decisions. You'll see in a second, okay? Of course, your actual amortization can never be longer than the contractual amortization, okay? I know it gets technical, but we'll get back to this here in a second, all right? So if you look at your mortgage statement and you'll see the amortization on that, that is your actual amortization. And if you've paid extra, it'll be shorter than your contractual amortization, okay? And if you have the right mortgage, we'll talk about that, you are allowed to go back, okay? And that's exactly, I just give you a clue there, okay? So mortgage rules, and this is where people get stuck a little bit, okay? So because the mortgage amortization period determines the time to pay off the mortgage, it should be no surprise to us that the government actually regulates the amortization period very strictly, okay? Very, very strictly. And of course, they use the amortization period also to control the housing market indirectly, right? In other words, if they tighten the amortization periods, then you can only qualify for less of a mortgage than before. So to give you an idea how things have changed before, in 2006, okay, 2006, when I got in just in the industry, listen to this, you could buy a rental property, not kidding you, with a 0 down payment and a 40-year amortization. Okay, so I have clients that have become exceedingly wealthy back in 2006 and 2007 from buying rental properties with a 0 down and a 40-year amortization. Well, those things have gone crazy in value and they've put none of their own money into the properties. So that happened. Today, good luck with that. It's not going to happen, right? Okay, so let's look at some of the rules associated with it. So if your down payment is less than 20%, okay, and the house is, there's other rules associated with this. You got to be careful. I'm only focusing on amortization right now. You can only put less than 20% down if the home is less than $1 million and you have, and it's your principal residence, okay? Then you must qualify 25 years and your highest contractual is 25 years also, okay? If you put 20% down or more and the home is less than $1 million and it's not a rental property, we call it a conventional loan, but it is insurable. What does insurable mean? Is the bank pays for the insurance on your behalf, okay? In that case, your qualification amortization is 25 years and your contractual is also 25 years, okay? Now, if you buy that same house, whether it's over $1 million or more than $1 million, sorry, less than $1 million or more than $1 million or $1 million, then you have the option to make your mortgage uninsurable. That's not a bad word. It just means that the bank cannot buy insurance at all. The government prohibits them from doing that, okay? When in this case here, you can actually, your qualification could be a 30-year and your maximum contractual also a 30-year, okay? That's important that. Okay, so if you put more than 20% down and it's your home you're living in, you can actually, for anything that includes a line of credit or a complex amortization, watch here, your maximum qualification amortization is 25 years, and for the mortgage portion, not the interest only, right? Because it doesn't have an amortization. You can typically go to 30 years still. Now, I show you this here. This is the strictest standard, okay? And in some of these, the bank has no option but to follow what the government says. They have absolutely no option, okay? In others, they have the discretion. They can always be stricter than the government, but they cannot be more lax than the government, okay? That's important to understand that, okay? So for anything that is a 100% line of credit, the qualification will be 25 years. And of course, contracts will be not applicable because it's a line of credit. It's an interest-only loan, as I talked about before, okay? So the question that probably comes into your mind is like, hold on, are there still lenders that give a 35-year or a 40-year amortization? The answer is yes, but a big caution. Typically, 40 years are not available unless you go with an alternate lender. What's an alternate lender? They still regulated by the government, but you'd get a rate of like 6%. Okay, they're not private lenders, but you can get that. There may be one prime lender. Prime lender is the best. Most of the people on this in this webinar probably qualify for them, that offer 35 years, but you would still pay a slight rate premium for that. So really, for all intents and purposes, you need to understand that most lenders have a maximum 30-year amortization for conventional mortgages, not insured mortgages, okay? Here's a bit of tidbit information for you to understand. In Canada, our regulators deem the 25-year amortization mortgage to be the standard mortgage, okay? They deem an amortization more than 25 years and less than 25 years to be higher risk, okay? So that's how we have to look at it also, okay? All right, you guys are not falling asleep? That's good. All right, so let's look at some strategies now, okay? But before I look at some strategies, I want to say this to you. It is really important, very important. If you have a mortgage that don't have the right terms and conditions, okay, you will not be able to implement some of the strategies I'm talking about. That's where exactly the life cycle cost comes into. You must have the right mortgage. So again, if you take a mortgage and you only rate focus, you may save yourself $10 a month. But this is not designed to save you $10 a month. This is designed to save you thousands, what I'm about to talk about. So now it's by focusing on an interest rate, you may be giving up some of these rights here. And so you're like, so you waste more money or you lose more money than what you're actually saving. So it's important to understand that you check with your lender to make sure that you are, and they may not even know what I'm talking about. I'm not being facetious here. Seriously, you'll see in a second what I mean. Okay. Also want to say this to you is some of these strategies, if I tell them to you and you went to your bank and I'm not being derogatory, they say, I'm looking to do this, they'll go, well, what is that? They won't necessarily know what you're talking about, okay? Because in a bank, there are very few people that are focused just on mortgages, okay? They are focused on investments, savings, a whole bunch of things. So as a mortgage broker, that's what we do. I do mortgages only. I do nothing else, okay? So it's important. I've seen where your mortgage broker is involved in the execution of the strategy. It's your decision. Once you want to make a change, you sign a form, we send it into the lender, and they make the change. But we can stipulate what the change should be so that it's executed properly, okay? And I'm going to tell you, it's important for you that not all lenders will actually partner with brokers to assist their clients, okay? And I don't know of any of the big banks that do that, okay? So I'm going to say I make no bones about my reluctance to place mortgages with lenders that prohibit me from assisting my clients when they need my help. Why am I so pedantic about that? Because I find it extremely irritating when I go buy something from a store and I come back the next day and I go, oh, can you help me? And I go, yeah, we can't help you anymore. You're going to send the warranty receipt now to wherever it is. I'm like, no, but I bought it from you. You know what I'm doing and you should know the price. You're right. You're face-to-face. You can help me. You're like, no, we don't just send the receipt to some other place you've never seen in your life, and who knows when you'll get an answer. It just infuriates me. So I absolutely make no bones about being reluctant to place mortgage with that, okay? And so just be careful. It can be very frustrating, of course, there, okay? All right, so now let's visit so important 2 points there. Let's visit some of these things. Okay, let's talk about the contractual amortization. Your lender's statement, again, will only indicate typically the remaining actual amortization. So to get your contractual amortization, you need to call your lender and ask them for it. Now, if you say, what's my contractual amortization? Seriously, you might even be like, what? What's that? Okay. They may not know what you're talking about again, but what you can do is, this is probably how they're going to calculate it. So what you do is, this is the formula. It's not rocket science, but it's important to know it because the whole concept of contractual amortization is very foreign to people. Okay, so what you want to do is to calculate your present or your remaining contractual amortization. You take the original contractual amortization. That's the one that's on your commitment. You have a 25-year mortgage. Okay, you take that 25 years. We'll look at the example in a second, and you subtract the time from the day the mortgage closed until today, and today being the day you're trying to calculate your contractual amortization. Okay, so let's use an example. Okay, so let's just say when you close the mortgage, you had a 25-year mortgage, and we convert it into months. You'll see why we do that. Okay, 300 months. Okay, but now today is 27 months since your mortgage closed. All right, and then the remaining actual amortization for after 27 months, what year? See there is 257 months. In other words, the client is, if you take 300, you'll see it in a second. I'm kind of setting you up here to see that the actual amortization is actually less than the contractual amortization. So let's see what happens now. So let's calculate the remaining contractual amortization. So what we do is we use a formula. We take 300 months, this thing here, okay, minus the 27 months, because that's the time elapsed since the closing date, and we get 273 months. So in other words, the contractual amortization, we have 22 years and 9 months remaining. Well, let's look at the actual amortization. 257 is 21 years and 5 months. So if I told you nothing else about the client's payments, you would immediately conclude, hey, Jacques, these folks actually paid more than what they were supposed to. And you go, you're right. Okay, so the contractual amortization, this is what on contract you have, okay? And this is what the actual, if you continue what you're doing, it's going to take you 257 months to pay off this mortgage, okay? So you'll see how we use it in a second, okay? So this is how you calculate your contractual amortization. All right, okay. This is the key. This is right here, the key, and we'll see some applications of this. If you voluntarily reduce your mortgage balance by making additional or increased payments, okay, a suitable mortgage terms and blah, 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 to return, you should be allowed to return your mortgage's remaining actual amortization to its remaining contractual amortization. So in other words, in plain English, if you really wanted to and you said, I can't, I've reduced my mortgage balance, but now, something's happened to my life and I really can't afford these payments that brought me to 257, you should be able to back up your actual amortization to be 273 months again. And then the payment will be calculated based on that. Okay, so watch now. You'll see how powerful this becomes when you do an example, okay? So doing this should reduce your regular minimum mandatory mortgage payment to match the mortgage's remaining contractual amortization period. You'll see how this works in a second, okay? It'll come together in the end, I promise you, okay? So here are some things that you need to be aware of. This is so important to understand, okay? Your mortgage, here's how the mortgage rules could affect you. I could use a gazillion examples, but this is one I see so often. Your contractual amortization period may determine and/or affect your mortgage eligibility, available mortgage products, future interest rates. Yes, future interest rates. So here's what you don't know about mortgages. Most people, again, focus on the interest rate, right? And so they want to get into a mortgage. I want to buy the house, Jacques, give me a mortgage, blah, blah, blah. And they don't pay attention to the stuff, okay? So what happens, they pick a mortgage, and then later the trouble happens. In 5 years' time, when they try and renew their mortgage, they get a worse rate here, even though they went for a cutthroat rate here. It's like the cutthroat rate's like 0.1 less, okay? It's not even a lot, okay? And they go, why is this happening to me? Because it is literally something you did back here, okay? It follows it through. And it's hard for me to be a broker to explain it, right? Because people are very interest rate focused. Okay, so watch here. A principal residence, very important, purchased for less than $1 million with a down payment of 20% or more, watch. You may be eligible for a 30-year amortization. You could, okay? But a 30-year amortization will cause the mortgage to become uninsurable, which could subject you to higher interest rates, both in the present and for subsequent mortgages. Okay, so if you have a 25-year, okay, and you want to go to a 30-year, but you don't have really a good reason to go to 30-year, you want to be careful because it's going to cost you to have a higher interest rate. Okay, so they don't tell you that. Okay, so be very careful about that. Okay, now here's the key. If you buy a house for more than $1 million, there is no rate difference between a 30-year, 25-year, 20-year, no rate difference, okay? So then you may as well just see what's best for you here. Obviously, in all cases, you want to just see what's best for you. But if you buy a house for less than $1 million and you have more than 20% down payment, a 25-year amortization will keep your mortgage insurable and get you better rates than if you went for a 30-year, which makes it uninsurable, okay? So important to know that, okay? This is something here when you talk about protection. And this is probably, I would say, one of the biggest things that you should use as a person. So I just went off a bit about the 30-year mortgage there, right? But I can tell you what, I always say idealism, you can't eat it, okay? If somebody cannot afford their mortgage payments, even if their interest rate's zero, it doesn't help them, okay? So for me, you gotta look at your protection first. So here's a good example. If you're feeling you're not so sure about your job right now, or you're a young family, still growing it, you may have another child, and you're going to be going down to one income for that period of time. What mortgage should you be taking? It doesn't matter if you go for a 25-year, then, because if you're struggling to pay the mortgage, then there's no point. Then you may want to consider a 30-year because you'll have options with that. Watch. Okay, so watch here. What you could do is, let's just say you go, you know what, I'm eligible for a 30-year, but I'm concerned about whatever my job. You can actually, and this is what we do for our clients, we'll say, why don't you qualify the mortgage for us, Jacques, at 30 years? Okay, so that my minimum mandatory payment is based on a 30-year mortgage. Okay, and then watch. You can then, once your mortgage is closed, you can voluntarily make additional payments to, let's just say, make it a 25-year. Now, again, if you have the wrong mortgage, you will not be able to do that, okay? So be careful about that, okay? And what that will do is, remember, this is the key. I have many people say, Jacques, no, don't give me a 30-year mortgage. I don't want to be paying for a 30-year mortgage. And I go, it's if you need the security, we just qualify it at 30 years. But then right after closing, we set your payments to be 25 years, right? And those 25-year payments they're gonna cause that your mortgage is paid off in 25 years, not 30 years. It's a safety thing. And here's the key, watch. If something happens then, right, you should be able to reduce your payments again. So let's just say you started at 30 years, okay? Right after closing, you said, nope, I don't want to take 30 years to pay off this mortgage. Make my payments 25 years, Jacques. No penalty for that. If you have the right mortgage, no penalty for that. Then, oops, something happens. You can say to me, Jacques, please take my payments right back to 30 year or to the contractual amortization, not quite 30 year, whatever the time lapse this year, okay? That's the strategy. So watch here, okay? A growing family anticipates reducing the household income to a single income during parental leave. They could have their mortgage approved at 30 years amortization, then make 25-year amortization equivalent payments right after the mortgage is closed. Upon the reduced household income, they should be able to lower their mortgage payments right back to their contractual amortization payments. Okay, and you'll see an example. We'll do a real example to show you what that looks like. Okay, very important to do that. And again, if you stare yourself blind against interest rates, then you're not going to be able to see the strategy, right? And so that, that's what's important to understand strategy. Affordability for me comes first, okay? Because again, even if the interest rate's zero, if you can't pay the mortgage, it doesn't matter. So affordability for me is always the priority to protect yourself, okay? All right, so here's something that people don't, and this gets a little bit complex, but it's so important, okay? So for these types of transactions, renewals, transfers, switches, and ports. So let's see what these are. Renewals I've just had a 5-year, I'm coming to the date that I have to renew my mortgage. That's a mortgage renewal, okay? Now, if you stay with your existing lender, it remains a renewal. If you decide to take your mortgage to another lender, that is called a transfer, okay? What is a switch? Midterm, let's just say like you're after 2.5 years or whatever else, oh gosh, rates are so much lower and I want to move my mortgage to a different lender because they give me a better rate. I'm prepared to pay the penalty. That's a switch. What is a port? Port means you bought a house here, okay? And you need to qualify for, very important, and you want to buy a house number Y here. Okay, if you qualify for the mortgage, you can actually take your mortgage with you. Okay, but there are limitations to that. And for all of these, there are limitations. So watch here. They are subject to very strict regulations. Okay, and that means the eligible mortgage is usually limited to either the greater or of the remaining contractual or the actual amortization period, depending on your circumstances. Okay, so we'll talk about an example about this specifically right now. So watch here. Note, choose your amortization period really carefully. Now, let me stop the bus. How many people who've got a mortgage here have ever been offered not a refinance? And a refinance, see, a refinance is not included in here. You can choose a new amortization, okay? You can do that anytime. But I'm talking for a renewal, transfer, switch. How many people in this webinar have ever been offered, hey, would you like the contractual amortization or the actual amortization? People are like, what? You probably fall on you're like, what are you talking about? Never heard of that, okay? But you got to choose carefully because your existing mortgage amortization period you choose for your new mortgage becomes the new mortgage's maximum contractual amortization period. Okay, what did I just say? Okay, so let's just say you start with a 25-year mortgage, okay? And now you have a 5-year mortgage term. After 5 years, you will have left over 20 years, right? 20 years. But let's just say you paid more and you're already down to 14 years. Okay, so now you should be, and the lender's normally not going to tell you this, they're only going to tell you this. Okay, so now you should have a choice between either this or that. Okay, now here's the key. Here's the key. If you choose this for your new mortgage, and now your new mortgage starts off, if something happens to you after 6 months, 2 years, you cannot go back and say, I want to go back to my 20-year. This becomes your maximum amortization. Okay, this has significant consequences. You'll see that in a second when somebody reports. I'll use this example here in a second, okay? Important you do that. Remember I said, if you choose to have the 20-year, okay, go back to the 20-year, the day after closing, so you close here, the day after closing, we set your payments again to make it a 14-year. So you lose nothing, but you have to have the right mortgage for that. If you have the wrong mortgage, you're going to be stuck in a 20-year mortgage, okay? So I try my best for all my clients to have the ability. So let's just say you've done 25 years, 5 years you're down to 20, but you've really gone great on your mortgage and you're down to 14 years. I'm probably going to suggest you, let's go back to 20 years, and you're going to look at me like, Jacques, if I forget to increase my payments, I'm really not going to be happy with myself. And I go, don't worry, we'll make you sign a form to say, Jacques, increase my payments. And literally the day after closing, Julia's in this meeting, she knows what we're talking about here. We will increase your payments to make it a 14-year, so you lose nothing. What's the benefit of it? We just talked about it. Something happens to you, you can back your payments off again to protect yourself, okay? And there's actually something else that we'll talk about in a second, okay? So most lenders will offer, we talked about this, will offer borrowers the remaining actual amortization on for these transactions, even though the remaining contractual amortization should be available, okay? But be careful, some lenders may not allow you to go back to your contractual, okay? So be very careful. Thus, be sure to request your mortgage's remaining contractual amortization and associated minimum payments from your lender if you need it, okay? So this is what lenders do. They send you a renewal agreement, and guess what? It's like, sign here, please, okay? It's like, there's no option to say, no, hold on. What are the options here? They go, no, sign here. And so that's where you need to, for me, most of my clients, I want to work with a lender that I actually get the renewal agreement first, and I can, if it's a piece of garbage, it's not even going to get to my client, okay? That's important, that, all right? Okay, so let's use an example. On its renewal date, a mortgage remaining actual amortization is 10 years, okay? So these guys have paid their mortgage nicely down, okay? But its contractual amortization is 20 years, okay? The borrowers feel really optimistic, and they choose the 10-year remaining amortization because there's no ways they're going to take 20 years to pay off this mortgage, okay? And then what happens is 2 years later, after the new term, they decide to sell their house, and they want, because they got a great rate right now, they want to port their mortgage to a larger home. But here is the catch now. Because their mortgage, the maximum contractual amortization, has now reset to 10 years, right? For the new mortgage, they chose 10 years. They didn't go back to 20. The contractual amortization is now 10 years. 2 years of lapse, so we take is the actual contractual is now 8 years, right? So follow me here. They had the choice between the 20 and the 10. They were optimistic. They took the 10. I love the optimism, right? And then they decide, okay, now that is almost the 10 has now become their maximum amortization. It can't go more than 10 after the closing date, right? So then 2 years later, they decide to sell the house, and they got a great rate. They want to port their mortgage, take their rate with them, okay? But now 10 years, 2 years after they started, they have only 8 years remaining. Well, guess what? In a port, guess what happens? You cannot go more than the contractual amortization. So now what happens is they have to qualify for the house that they want to upgrade to at 8 years, right? You can't, the qualification, you cannot go back to 25 now, all right? Because what happens is you are then breaking the mortgage terms and conditions. So now they don't qualify, and they lose that great rate, and they incur a penalty, and they have to apply for a brand new mortgage. Obviously, then they can choose a 25-year or something like that. I'm just saying to you, what you want to do is be very careful at renewal or for any of these things. When you choose your amortization, try and go back to your contractual if the mortgage allows it, so that you have options later on. We did a mortgage for clients last year. They took a 30-year amortization. Because they told us, they said, look, we're probably going to buy a house in 2022, and rates are low in 2021. They said, but, I said, look, if you guys are going to do that, and they said the house is more than $1 million anyway. I said, if you're going to do that, let's then get you 30-year amortization. Well, guess what happened? They bought a house, and they were down to 29 years. Easily qualified for the house because they went back to a higher amortization. If they went to the optimistic, let's do 23 years, they wouldn't have qualified for that house, and they would have lost that beautiful rate, okay? So there's a lot here but it's really important for you to understand that, okay? Okay, this is probably going to pull it together for you, okay? So, and for those who obviously my clients, you've seen these, probably tired of them. So let's take, yes, Sean and Mary bought a house, $950,000. They put, less than 20% down, and the mortgage is $791. By law, they could not exceed 25 years, and this was their maximum purchase price. Why? Because look, the law says they've got great credit. They cannot exceed 44 for the GDS here, cannot exceed 39. So they essentially like to their maximum, right? But they go, man, so if they try to go shorter, 20 years, they would not qualify for this home anymore, right? And so like, oh man, but we'd really like to pay our mortgage off. But they go, but our family's also growing, so we don't want to be like doing silly stuff here, okay? So what happens? Look, they get qualified, and there is fixed rate, and here is the payment, and the property taxes, blah, 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 right? Now what happens is, right after closing, the day after closing, they go, Jacques, we really want to pay this mortgage off for 20 years. And I go, no problem. We set it out for them. We get the right mortgage. And this is now their mortgage. Look how much their payments increase. Boom, like they're paying $603 a month extra, but they want to really hammer. They got the cash flow. Both of them are working. They want to do it. Now, actually, look, if they try to do this, if they try to qualify for this, they wouldn't qualify. But once you've qualified and you're in the mortgage is active, you can increase your payments as long as it's inside the mortgage's terms and conditions. Okay, so they go great. They hammering this mortgage down. And after 2 years, okay, so they closed here. The day after closing, they asked me to increase the payments for them, and this is what the new payments become. And then 2 years after, starting the mortgage, they go, oh gosh, we got a family, we're growing a family, we're going to go down to one income. Now watch, 2 years lapse, right? We had 25 years here. We calculate the contractual amortization, 25 minus 2. Our new contractual amortization is 23 years. Okay, well, in this great mortgage, they can go right back to 23 years. Okay, guess what happens? We calculate the payment based on that. Look at this. Look at this. This actually less than that. Okay, so these clients are saving another $90 over what their minimum payment would have been. Okay, so that's great. It's like dropping, look at this here, like dropping down almost $700 a month, dropping their payments. Well, guess what? Baby's mom and dad are back at work, both. They can go back right here and say, Jacques, let's hammer it again. You can do that if you have the right mortgage. And so this is where you can play with your contractual amortization, right? Because even though they're down to 20 years, we go back to 23. And so the client is in control of their process. That's the great way of doing it. So here's a hint for you always. Also, if you do have extra money, remember you got to plan for your retirement also. So please don't put all your money in your mortgage. You got to plan for your retirement also. I'm not a financial planner, but that's so you got to please do not put all your money in the mortgage. Plan for your retirement, okay? And so a great tip for you is if you can pay a little bit extra and you have the right mortgage, an emergency hits you, you've always just been through COVID, you could then back it off because you built a little reserve for yourself, so to speak, so you can go back to the contractual amortization. Okay. Hopefully this is helpful. I see a question here, Danny, for 35 years. So I will get back to you about that. So this you can see is now look at the TDS here, right? It's back right off and comfortable, much more comfortable right now. So this is how it works, and it's really important I'll get to it in a second. So hopefully this ties it together for you. Know what your contractual amortization is. Have the right mortgage that you can, quote unquote, move your payments as you need, okay? Make sure that you understand the rules associated. Don't be talked into a rate. If you focus on rate, you're inevitably going to make the wrong mortgage decision, okay? Focus on the right product. And I've spoken about this lots of times. How would you know typically you get the right product? This is anecdotal, okay? If somebody spends time educating you, okay, that is a good clue, okay? If somebody if you say to somebody, I'm looking for a mortgage, and they go, yeah, we got a great 5-year fix, and you go, yeah, no, oh, don't worry, I got a great 5-year variable, and they jump just from rate to rate, be careful, right? They'll sell you any rate, not because it's good for you, because it gets them the deal, All right. So if somebody educates you like real numbers, all my clients, this is one page that my clients get. Okay. Real education, you're probably going to get a mortgage that's healthy. Okay. But again, make sure there's no other conflicts of interest also. All right, so I am going to just quickly let you know this, and then we'll talk about some market updates. All right, so your mortgage amortization obviously is a big deal. You should be careful with it, okay? And this is how, let us help you to get the right mortgage, okay? So let's talk about the market for a second. Okay, so everybody, we do this every webinar now. We give a quick little market update. So in Canada, we typically, the 5-year fixed rates are focused on the the Government of Canada's 5-year bond yields, okay? And you can see this is kind of COVID here, okay? And so I think the second is the third, and you can see obviously things happened here like crazy. And so that's why rates have gone up so crazy. We'll talk about some rates in a second. And lately something has happened here. Okay, so it's come down slightly. So if you follow this curve, and it's very hard to put a number to it, typically the rates, the discount rates they can vary between 1% to 2% above this. So the actual rates, if you look at this curve here, are normally between 1 to 2% above this curve. So for us in the industry, when this curve moves, we know rates are going to go move. Okay, so that's what we drive. And you can see the reason why rates are going crazy is because of the bond yield. So when the Bank of Canada announces a rate increase, okay, that has very little to do with fixed rates. While their announcements can affect fixed rates, it does not directly determine fixed rates, okay? So here's the shocker. It was just been 13th of July. We all thought, 0.75 was going to be a lot. The Bank of Canada moved the rate up by a full 1%, okay? And you can see this when they did it, all right? In the next, so this is the 13th of July. The next Bank of Canada meeting is on the 7th of September, 2022, okay? And it is expected they will probably move it up again then, all right? So if you're in a variable rate, I did a video and I sent it out to all my clients. Do be careful about that, right? So don't panic. There's a lot to be talked about there, but essentially that's what's going to happen here, all right? Okay, so why is this stuff happening? Is because of inflation. And so here's Canada sitting at 8.1%, and the Bank of Canada's target is 1%, right? So we're quite above about that. Now, I'm not trying to be flippant about it, but I'm from South Africa originally. Now, most people in South Africa, they'll go, you call that inflation? That's not inflation, man. And I get it, but we live in Canada, and so this is not good for our economy. And so that's why I really feel sorry for the Bank of Canada. By the way, I'm not an economist. I'm not trying to be one, okay? I'm just saying it must be horrible to be Bank of Canada right now, because guess what? You either raise rates, all right, which nobody likes, and to stop inflation, or you drive the economy into a recession. Like, which one do you choose? Like, there's really no good option in that sense. You gotta like, the medicine is tasting pretty bitter right now. So we don't know when this is going to turn. We do not know. Okay, so that's important for you to note. So let's look at some representative rates right now. 5-year fixed, actually good news. We got a rate decrease today. I said it, a rate decrease today, and I think we got one earlier in the week also, or late last week also. That's good, and you can see this here at the bond yield. See the tip here? It's curling there. Let me just wipe it out. So see there? It's coming down a bit. We don't know for how long, but we'll have to see. Okay. Okay, so that's kind of your representative rates right now. 5-year fix, 4.79, 5.34, depending on what type of mortgage you get. And then the prime rates, now be careful, not all lenders have the same prime rate. So adjustable rates are, essentially 3.8 or 4.4. They vary between what you do there. Okay. All right. Good night. Have yourself a great night. Bye-bye.